Have you ever felt like you're doing everything right, but the American dream keeps getting further away? You work, you save, you try to be responsible, and somehow, every time you check home prices, mortgage rates, or your bank account, it feels like the finish line moved again. If that's how you feel, you're not imagining it. Because right now, the US housing market is doing something that should not be possible. Home sales have dropped to their lowest levels in decades, yet prices are still sitting near all-time highs. That is not a normal market. Normally, when fewer people buy, prices fall. But this is not a normal market. This market is frozen, and it's being held in place by something economists call the Golden Handcuffs. Today, I'm going to show you exactly what that means, why more than half of homeowners are effectively trapped, and why millions of first-time buyers feel like the system is punishing them for doing everything right. Let's start with the math.
By the way, if you're trying to increase your income instead of cutting expenses, I've linked side hustle resources in the description. It's worth checking if you're looking for additional income opportunities.
Imagine you bought a home in early 2021. Back then, you could lock in a mortgage rate around 2.65%. At the time, that may have felt normal. Now, look at where we are today. Mortgage rates are around 6.5%. On paper, that sounds like a few percentage points. In reality, it is a completely different financial world. Take a $400,000 home. At today's rates, that same home can cost roughly $730 more every single month compared to what it would have cost at those ultra-low 2021 rates. Same house, same bedrooms, same neighborhood, same commute. But now it costs you thousands more every year. And that difference is exactly why the market feels stuck. Because if you already own a home with a rate below 4%, moving doesn't just mean changing houses. It means giving up some of the cheapest money you will probably ever borrow in your lifetime. That is the handcuff. And right now, about 51% of all US mortgage holders are wearing it. Think about that for a second. More than half of homeowners are sitting on mortgage rates so low that selling their house and buying another one would feel like lighting money on fire. In fact, Federal Reserve researchers found that the financial penalty for the typical homeowner to move today is more than $65,000. That is not a rounding error. That is not a minor inconvenience. That is a serious financial hit. So when people ask, why aren't more homeowners selling? That's your answer. Because to move, many of them would have to voluntarily accept a massive increase in their monthly payment, even if they bought a similar house. And most people look at that math and say no. Not because they love their current home so much, not because they never want to move, but because the financial trade-off makes no sense. That is why inventory stays tight. That is why supply stays low. And that is why prices remain stubbornly high, even when demand weakens. But this is bigger than economics, because behind every market trend is a real person trying to build a life. So let's talk about Maya. Maya is 31. She works in healthcare. She earns $74,000 a year. That is above the national average. She has saved $31,000. She has strong credit. She hasn't been reckless. She didn't max out a dozen credit cards. She did what people told her to do. Work hard, be responsible, save money, wait your turn. By the rules a lot of us grew up hearing, Maya is a success. But if Maya tries to buy a median-priced home today, housing alone could eat up around 65% of her take-home pay. Not her gross pay, her take-home pay. That means after the mortgage, taxes, insurance, and the basic cost of ownership, there's barely enough left for groceries, utilities, gas, emergencies, or even a normal social life. That's the part that doesn't show up in the polished real estate ads. For millions of Americans, homeownership no longer feels like a milestone. It feels like a financial stress test. So if you feel like Maya, hear me clearly. You are not failing adulthood. You are not behind. You are not irresponsible because this market feels out of reach. The math is broken, and the frustration you feel is rational. In the 1990s, the typical first-time homebuyer was around 28 years old. Today, that number is closer to 40. That is not just a personal delay, that is a structural warning sign. An entire generation is being told to play a game where the rules changed halfway through.
Now, at this point, a lot of people are waiting for the same thing. A crash. Another 2008. A big reset that finally makes housing affordable again. And I understand why. Because when prices are this high and affordability is this broken, it feels like something has to snap. But here's the problem. This is not 2008. Not even close. Back then, banks were handing out loans with much looser standards. A lot of buyers were stretched beyond what they could actually afford. Speculation was everywhere, and many homeowners had very little real equity protecting them. Today, the setup is different. Lending standards are much tighter. Most homeowners are sitting on significant equity. They are not underwater on their loans. They are locked into great loans. That distinction matters because a market full of fragile homeowners can crash fast. A market full of homeowners who don't want to give up their low rates stays frozen. That is exactly what we are seeing now. And then there's the second problem, supply. For years, the US did not build enough homes, especially starter homes, the kind of homes first-time buyers actually need. We are now short by nearly 4 million homes, so even when buyers pull back, the market doesn't suddenly flood with inventory. Why? Because there was already a shortage to begin with. Now combine that housing shortage with millions of existing homeowners refusing to sell, and you get one of the strangest markets in modern history. Too few homes, too many owners locked in, and too many buyers being asked to accept payments that barely leave room to live. That is not a healthy market. That is a bottleneck. So the question becomes, what do you actually do if you're on the outside looking in? First, stop listening to people who say it's always a great time to buy. It isn't. If a mortgage is going to consume 45% of your income or more, that is not automatically a wise investment. That can become a trap. A house is not a trophy if the payment destroys your flexibility, drains your savings, and leaves you stressed every month. Sometimes the most grown-up financial move is not buying just because everyone says you should. Sometimes the smartest move is waiting. Second, consider the path people love to dismiss, renting and investing the difference. A lot of people still repeat the phrase that rent is throwing money away, but in a high-rate environment, that thinking can be far too simplistic. If renting keeps your monthly costs lower and you consistently invest the difference into broad index funds or retirement accounts, you may build more wealth than if you stretch yourself into an overpriced home with a painful mortgage. Renting is not throwing money away if it buys you flexibility, protects your cash flow, and gives you time to grow your net worth. That is not failure. That is strategy. Third, look at new construction. Builders are one of the few players in this market who still have an incentive to make deals happen. Many are offering rate buydowns to the 4.5 to 5% range just to move inventory. That changes the math, and right now, that matters, because in a market where existing homeowners are locked into ultra-low rates and refusing to sell, builders may be one of the only places where buyers can still find leverage. Not everywhere, not in every city, but it is one of the few real openings in this market. So yes, this housing market is frustrating, and honestly, it's okay to be angry about it. It's okay to feel like the rules changed, because they did. But do not let a broken market convince you that your financial future is broken too. Your value is not determined by whether your name is on a deed, and your future is not over just because the timing is bad. The best thing you can do right now is run your own numbers, protect your cash flow, and refuse to participate in collective financial insanity just because everyone else is pretending it's normal. We're going to keep tracking the real numbers here, without the hype, without the fantasy, and without the pressure to force every decision into a one-size-fits-all answer. So if you want honest breakdowns on housing, money, and the economy, hit subscribe and join the community. And let me know in the comments, are you locked into a low rate and refusing to move, or are you still on the sidelines waiting for the math to make sense? I'm Mikey Finance, and I'll see you in the next video.
Before you go, remember that building wealth isn't only about saving money, it's also about increasing your income. If you're interested in starting a side hustle or earning extra income online, I've included a recommended platform in the description below. Check it out, see if it's a right fit for you, and always do your own research before getting started. If you found this video helpful, don't forget to like, share, subscribe, and I'll see you in the next one.